Hi, everyone. Welcome to Keystone Financial Services Forecast 2014. This is Josh Nelson. I'm a certified financial planner professional and also the founder and CEO of Keystone Financial Services. At Keystone, our mission is to guide our clients to achieve financial security by building trusted relationships and providing expert financial advice, exceptional service, and proactive communication. Let's get started. Let's start by talking about where we've been. 2013 was a good year, depending on where you were invested. The S&P 500 was up 30%. The 10-year Treasury yield was about 3%, almost double where it started the year, meaning that if you owned bonds, especially Treasuries, you probably saw a decline in value. Gold was off 28%, and finally emerging markets were down 8%. One of the fun parts about our forecast events is looking back to what the experts predicted and what actually happened. In their 2013 mid-year stock market outlook, our friends at LPL Financial predicted rocky terrain and an uptick in volatility. Quite the opposite happened, as the S&P 500 gained 14% and volatility dropped 26% from the end of June to the end of the year. And now the finalists for worst financial predictions of 2013. BlackRock's Byron Wien said gold would reach $1,900 an ounce, and the S&P 500 would fall below $1,300 in 2013. Sorry, Mr. Wien, you were nowhere close, as gold finished the year at $1,200 an ounce, and the S&P 500 finished at $1,842. Harry Dent, known for his wild financial predictions over the years, said the Dow Jones Industrial Average would fall below 5,000, yet it finished the year at 16,481. And finally, the average Wall Street bank predicted the S&P 500 would end the year at 1543, but finished at 1842. Our point is that if the experts get it wrong so much of the time, the odds of an investor being able to successfully time the market are very low. As you can see, the experts are all over the place for their projections going into 2014. As is typical, there is no consensus opinion for how the markets will fare in 2014. However, it's noteworthy that nobody is projecting a drop in the financial markets this year. In this slide, you'll notice that the S&P 500 has rallied an impressive 30% in 2013. But how does that performance rank against the historical performance of the market? The answer is not as great as you might think. According to J.P. Morgan, a year in which stocks rally more than 20% isn't all that uncommon. In fact, 1 in every 3 calendar years since 1897 have seen equities rally by more than 20%. While investors have been, on average, deprived of normal market conditions since the turn of the millennium, history would show that it's 3 times more likely to have equities return double digits in a calendar year than to have single-digit gains. 2013 wouldn't even crack the top 20 of all-time greatest years for stocks. We should actually expect more years like this and not let the recent decade of lackluster performance of stocks distort our ability to understand history. The change to the central bank policy equates to the Federal Reserve reducing their monthly asset purchases by $10 billion to $75 billion as a result of a strengthening U.S. economy. While the Federal Reserve balance sheet, which has reached nearly $4 trillion, will still continue to grow, it will do so at a slower pace. Interestingly, Ben Bernanke was quoted as saying, "The action today is intended to keep the level of accommodation the same overall and to push the economy forward," at a press conference with reporters following the release of updated Fed policy. Therefore, while the tapering everyone was waiting for did in fact happen, the level of Federal Reserve intervention in the markets has not changed when factoring in the new commitment to keep interest rates at record lows for the foreseeable future. Janet Yellen has been working right alongside Ben Bernanke as the Fed has used various methods to enhance economic growth and the prices of financial assets. If she's any different, she's been on record as actually being more supportive of an aggressive use of quantitative easing to help improve the economy. This should be a smooth transition, and policy is likely to remain the same. The U.S. Labor Department announced 203,000 net new jobs were created in November, besting consensus expectations for a 185,000 gain, according to Bloomberg. Furthermore, the headline unemployment number dropped to the lowest level since November 2008 and now stands at 7%, as depicted on the chart. The report indicated broad strength across many industries, including overall factory jobs breaching the 12 million mark for the first time since 2009. The job market here in the U.S. is clearly improving, and the results are showing up throughout the rest of the economy. This trend is likely to continue, and it will be beneficial for stock investors. Perhaps most interesting, the labor participation rate, or the percentage of the working-age population that either has a job or is actively seeking employment, was near the lowest level seen since March 1978. This should be interpreted as a positive sign for the health of the U.S. job market, because despite more people entering the workforce, the unemployment rate still managed to decline from last month. This has much more to do with the demographics of our nation than people dropping out of the workforce because they can't find a job. Not much of a concern, plus it just recently finally reversed for the first month in a long time in November. According to the S&P Case-Shiller Index of Home Prices, homes appreciated at an annualized rate of 13.3% through September 2013. Furthermore, the pace of home construction reached a more than 5-year high in November, according to Bloomberg. The most recent data from the Commerce Department would indicate home builders are struggling to keep pace with still strong demand for new homes. Housing has been a major missing link from economic growth ever since the bubble burst, and now that it's picking up steam, we have yet another major catalyst to help propel stocks higher. As indicated on the chart, mortgage rates are still way below average despite having increased from bottoming out in 2013. Even if they continue to tick higher, it shouldn't deter people from buying homes because the borrowing rates are still very low on an absolute level. This chart shows two types of inflation, CPI, or the Consumer Price Index, and PCE, the Personal Consumption Expenditure Index, which is the favored metric of the Federal Reserve. Whichever you prefer, the message is the same. Inflation still is really low. This allows the Fed to continue stimulating the economy and the financial markets and proves the fear of their policies resulting in massive inflation are unfounded and inaccurate. As you can see, Americans are actually more rich than we've ever been. We've more than recovered from the recession, and chances are this will continue. Earnings growth has been muted, but it's still positive. Also, we should expect this to gain steam in 2014 and 2015, as the green numbers would indicate 8% growth in 2014. As the economy continues to improve and overall sentiment rises, earnings growth will accelerate, resulting in more gains in the stock market. Europe was the biggest distraction for the markets in 2011 and 2012, but things seem to be considerably improved if the stock markets are any indication. Investors have overcome their fears of a European collapse and have sent shares soaring in those nations previously labeled as troubled. This indicates things aren't nearly as bad as people once feared. Europe finally figured it out by copying the U.S. Federal Reserve. Instead of trying to worry about cutting deficits during tough economic times, the right way to handle the current environment is to do everything you can to stimulate the economy. The European Central Bank has been doing just that by cutting interest rates to record lows, and the results have been great. Coming into the year, some feared China's economy was slowing. While their economy did in fact slow down slightly from last year, it's still growing at an impressive 7.6% this year. This is a very strong rate of growth for the second largest economy in the world. Now let's talk about what we're watching in 2014. This chart shows the U.S. Treasury yield curve from today, 1 month ago, and 1 year ago. Interest rates are increasing, however, they're still very low in terms of historical averages. Rates would have to increase by a lot more before they become a problem from economic growth. Plus, rising interest rates is much more damaging to fixed income investors who may now finally take some of their money that has been in bonds and put it back into stocks. When the Federal Reserve initially gave an indication in May they were considering reversing their quantitative easing programs, these foreign currencies declined in value against the U.S. dollar. The Fragile Five is a reference to the 4 countries listed on the chart, plus South Africa. Now, all of the capital that left the United States in desperate search of yield will potentially come back to the United States. These economies are not material to the global economy, and their struggles are not that much of a concern to the U.S. stock market at this time. This chart depicts cumulative asset flows into equity and bond funds from November 2012 to November 2013. As you can see, demand for stocks is escalating as demand for bonds is declining. This trend should continue to gain steam as interest rates rise due to less Federal Reserve quantitative easing. These assets will likely be destined for stocks and help propel the market higher this next year. As the table depicts, stock valuations actually aren't that high. In fact, given where interest rates have been this year, you could argue the PE ratio is extremely low based on history. As you can see on this chart showing the historical range of the PE ratio on the S&P 500 from 1999 through 2013, valuations currently aren't that high for stocks. We're not even close to the valuations we saw in 1999 and 2000. Therefore, we may not even need much earnings growth for this rally in stocks to continue marching a bit higher. This chart confirms the obvious. Most people are upset with their lawmakers, and there could be a very high turnover rate in Washington during this particular midterm election. Markets like gridlock. No new policies that get in the way of economic growth is good news for investors. A CNBC survey showed that 46% of respondents oppose Obamacare. 37% of the same respondents opposed the Affordable Care Act. 29% of respondents approved of Obamacare, yet 22% of respondents approved of the Affordable Care Act. The fact is, a lot of people don't even know what the law entails. However, considering it has been such an important talking point and prominently displayed on headlines and the subject of a lot of TV shows, people want to know how it will affect the financial markets in 2014. The answer appears to be a resounding, nobody knows. Most people don't know what it even is, and even the experts can't decide on how much it will affect the financial markets or the economy. 61% of employers believe Obamacare will result in higher health care costs, 20% of which believe the increase will be 5% or more next year. This chart indicates more of the potential negative consequences of Obamacare. It's a matter that should be addressed and monitored, but nobody is quite sure how it will affect the economy and financial markets. The cartoon shows Dennis Rodman telling North Korea's leader, Kim Jong-un, not to cross the red line. It's an attempt at humor on geopolitical dysfunction, and that Dennis Rodman attempted to be an ambassador to our nation's troubled rival North Korea. Geopolitical events often have a way of swiftly and unexpectedly impacting financial markets. Thank you for attending. We appreciate your continued support and encourage you to contact us if we can be of any help to you, your family, or a friend. Please visit us at www.keystonefinancial.org. Once again, thank you for attending Forecast 2014.